Hello everyone, thanks for joining us. We thought it was important to go through some of the recent changes that have happened to capital gains tax affecting expatriates with their property that they may have lived in as their previous family home. It's obviously caused a lot of concern around the world. A lot of people are asking the questions, they're not sure what the right advice is. So the aim of today is to hopefully give you a very good understanding of how this may impact you and how you can plan around it to ensure that it has minimum impact on your personal circumstances. As with all things, we have to start these days with a disclaimer. Just a reminder, you need to seek personal advice in order to get the best outcome. So please make sure that you enjoy the seminar, but seek personal advice for your personal circumstances. A quick history lesson on where this change came from. It was first introduced in the May 2018 federal budget. It did pass the lower house pretty quickly, but we managed to hold it up in the Senate for quite a while. SMATS was working in conjunction with Australian Hong Kong, who worked very, very hard to convince the government of the day that this was grossly unfair in its original format. We argued hard that there should be some provisions in there in case people were forced to sale, when the original legislation had none. That did allow us to get support from both the government and the opposition in delaying the bill, and it actually lapsed when the election was called in April 2019. Unfortunately, the government took it upon themselves to reintroduce the legislation in October 19. They did make the changes to incorporate some concessions for death, divorce, and also for financial hardship. And that then caused both parties to support it, and the bill quickly passed into law in December 2019, much to our disappointment, but it's now law, it's now in effect, and it will impact you in some way. In regards to who will be impacted, it's not going to affect everybody. It will only affect you if you actually lived in your property before you went overseas. So if you have just got investment property that you never lived in, this law has no impact whatsoever on your situation. It will only affect you if it was your former residence before you moved to live permanently overseas and became a non-resident. There are no past exclusions, and this is one of the harshest things about this legislation. It doesn't matter how long you've owned your property, how long you lived in it, it's going to have an impact all the way back to your original acquisition if you sell your property while living overseas. So you've got to be very, very careful with these changes. To give you an idea, there will be no change or impact if you never lived in it. If you acquired the property whilst living abroad, if you sell the property before 30th of June 2020, there'll be no impact at all because there are some concessions leading up to there. Or importantly, if you sell the property after you return to live permanently in Australia. This is one of the main issues that the government said, hey, we're going to pass the legislation because it's no big deal if they wait till they come back and sell. It's only going to affect you if you sell after June 2020 and you're living overseas. And the concessions that are now available is if you pass away, if you get divorced, or if you're in financial hardship and forced to sell, then there are some concessions to ensure that you still maintain some or all of your previous residence capital gains tax free exemptions. What's happening, and I just thought an example would be the easiest way to explain it. I'm just going to assume that young John Smith bought a family home in 2001 for $300,000. He lived in that home right the way through to 2016 and then moved to Singapore. And it was worth approximately $450,000 at the time he moved out in 2016. He then subsequently sold that property in 2021, importantly, after the 30th of June 2020, when that law comes in, for $550,000. To show you how that would impact his capital gains, under the old rules, the $550,000 sale price would only be capital gains on the value above the market valuation on the day he moved out, which was $450,000. So his taxable gain would have been $100,000. Because he sold the property within 6 years of leaving Australia, under the old rules, he would have got an entire capital gains tax free exemption on that profit, and therefore the tax would have been zero. The new rules are very harsh. There is no adjustment for the value on the date of departure. He has to pay capital gains tax right the way back to the original purchase price of $250,000 And in this case, sorry, of 300,000. So that would leave a profit of 250,000, which would be fully taxed at his prevailing personal marginal tax rate. In this case, as an individual living abroad, that would be $94,000. So you can see a significant uplift from the current zero to a now $94,000 cost on a reasonably modest house. And that's despite the fact that he lived in that house for over 15 years before he left Australia. You can see if he didn't sell the house until such time as he had moved back to permanently live in Australia once again, then the tax would once again come down to zero, because he would be entitled to all of the concessions, being the 15 years tax-free, the 6-year cessation. Everything would just happen as if he had never left at all. And hence the importance of waiting that period to sell the house when you are back in Australia. It was worth, in this case, $94,000 and could be substantially more if that house had a bigger value. If he had lived in the house prior to leaving Australia under the current rules, he would be prorated on how much would be taxable rather than the value on departure. If we look at the situation, if he had stayed longer than 6 years away from the property, the calculation is slightly different. What would happen here is he still has the same sale price of $550. Under the old rules, he'll still get the concession that he only pays from the market value above. So he's got a $100,000 gain. But because he's now gone 8 years, 2 years past the 6-year, portion of this will now be subject to tax. So 75% will be tax-free, 6/8, 25% taxable, or in this case, $25,000. And at the 32.5% non-resident rate, that would be $8,000 tax to pay. You can see here, if you went there, it wouldn't matter that he would live longer because he doesn't have any concession under the new rules for any time living in the property whatsoever. So it's fully taxable, still $94,000. And if you went back, the same rules would apply. It would be down to $8,000. So definitely the advantage is to wait till you're back in Australia. That's very, very important to do so. Again, pro rata if you'd lived in it prior. So the big question is, should you keep your property given the changes have come in? And I suppose the biggest issue is, do you believe the tax saving of selling prior to the 30th of June is worth taking for losing the opportunity for growth? Now that's going to be a question for every property individually. It depends where your property is in the cycle. Is it a growth cycle? Like currently Sydney is very strong, as is Melbourne. But other properties like Perth market and Brisbane to a lesser extent are a bit soft right now. So their potential might be better for growth than the tax saving on the table. So you have to be very, very careful to not shoot yourself in the foot, because you might take the tax saving now thinking you're doing the right thing and save maybe that even $94,000, but then find out that the property went up $200,000, $300,000, $400,000 in the fullness of time, and you've now missed out on that. So be very careful to make the decision based solely on tax. Evaluate it as an economic thing. You also need to look at, do you intend to go back and live in that property? If so, then the tax changes will have no impact on you, because as long as you go back to live in Australia and potentially live in that property, the changes do not apply. So don't sell if you're intending to go back and live in it. One of the big questions I ask clients all the time when they're debating whether they should keep or should sell is to maybe ask yourself, would you buy at today's price? If you think it's more expensive than it's worth, then maybe it's worth cashing in your chips on an economic front, but again, not for tax. If you think that it's cheap, keep it and enjoy the future growth. Have a look at when you think you will return to Australia and if that's possible, and when will that be? As long as you don't sell your property until after you've returned, these changes will not impact you. Having a look at some strategies on how to save tax. Well, if you're thinking about selling, make sure you do sell your property prior to the 30th of June, and then you'll be excluded from any of these changes. Importantly, that is not the settlement date, it is the date of the sales contract. So as long as you sign a sales contract before the 30th of June, the old rules will apply, not the new rules. Obviously, the time is ticking on that very fast, And you've got to be careful if you're getting close to June and you haven't sold it, make sure you don't sneak over the line and accidentally fall into the next financial year. It's very costly if you do so. Make sure, obviously, you do not sell until after you've returned to live in Australia. A reminder, that needs to be a permanent relocation. You cannot go back for the weekend, sell the property and say, hey, I was in Australia, the old rules apply. You have to have permanently gone back. That may include giving up your job, sending your furniture and belongings back, relocating your family. If you can't show that it's a permanent relocation, the fact that you just happen to be in Australia for an extended holiday will not get you around these rules. You could go and consider an open market sale now, or you might want to take advantage and upgrade, sell now, take the tax saving and get a better property, so that you're replacing one asset with the other. That could be a smart play to accelerate and use the 30th of June date as your motivation. You might also want to cash it in to go into an alternate investment if you think that alternate investment is going to outperform your potential property. But be careful, because the devil you know, the devil you don't. Of course, mindful that you need to have that sale contracted prior to the 30th of June. You could also consider transferring the property to a trust, a family trust, or another member of your family. What that would achieve is allowing you to sell the property technically, realize the previous tax-free portion, and then have a new owner that would just be subject to normal tax. But you'd crystallize all the tax savings and ensure that they're protected. Now, you'd only do that if you thought you might sell the property before returning to Australia. One of the reasons for that is that transfer to a family member or a trust or related company would incur full stamp duty, and it would also trigger any CGT costs that may be built up at that time. Now, obviously, if it was your family home, that may not be substantial, but it certainly needs to be considered. One of the advantages if you are overseas is try and make sure you fund your next property acquisition through debt release, getting the equity in the property and drawing on it, rather than the sale, particularly if it's after the 30th of June 2020. You certainly don't want to do a sale. It'll incur too much cost, particularly from the potential of tax. So the debt will release the same amount of funds, but mean that there's no tax trigger until you're back in Australia, can sell the property and pay back the debt at that time. Predicting the future is never easy, but if you are contemplating what you should or shouldn't do, it's very important you sit down with your partner and go through the options and say, well, how is this going to impact us? Can we get close to what we think the future will be? And you need to consider things like, will you return to Australia and when? As I mentioned, can't say it enough, as long as you're back in Australia when you sell the property, these changes do not apply and you'll get the benefit of any previous capital gains tax-free period on your residence. You've got to consider what's on your horizon in terms of when you might want to sell it and why you might want to sell it. You want to look at whether the property you've got now is the suitable one for your return. Will you likely live in it, or are you going to intend to sell it? And of course, will you need the money? And that may be you want to start a business, upgrade your lifestyle, investment, or even things like kids' schooling should be considered. Where will they stay if they go back to study in Australia? And of course, you might want to, at some stage, upgrade your lifestyle. Now, you should use debt, as I mentioned, but what if you can't get a loan? That could stop you doing it. So you need to consider your future in deciding what you should act on in the present. Something that's important to remember to finish off for you is it's absolutely crucial that you get yourself professional advice before you make any decisions. You need to know how much that tax cost could potentially be, how much you'll save, how much it might be, so that you can make the best decision for your circumstance. Everybody will be different because the time you lived in the property, the value it is, the capital gain it's achieved, they'll be different for everyone. So get advice appropriate to your circumstances. We're always here to help. Absolutely categorically, once you're past the 30th of June 2020, don't sell the property whilst living overseas. Wait until your return to Australia, if at all possible. The saving could be significant, so you don't want to miss it by just a little mark. Make sure you factor that in and have your planning set to logically sell on return where these changes won't hurt you. Importantly, don't let tax be the only reason you make a decision. If there are economic reasons to sell the property, even with the tax cost, that may be better for you than waiting to save a few dollars in tax. That's especially true if you lose confidence in the property market. If you wait and sell later at a lower price, the tax will be lower anyways. But you probably wanted to sell at the better day rather than the lower day. So don't let tax be the only reason you do something. That's never ever a good reason whatsoever. I hope that was helpful for you. We put that together so you can get some factual, quick information. As always with ATS, we've been here since 1995 and we're looking to help you. If you need help, we're certainly there. Jump on the internet at smats.net or give us an email at tax@smats.net, and we'd love to help you through the confusion and ensure you have a low or no tax future in Australia on your former family home. Thanks for joining us.